Good afternoon, everyone. This is Steve Sabaji. I'm coming to you live today from Austin, Texas for Quest Trust Company for our Self-Directed IRA Saturday. And I think we have what's going to prove to be a very great topic for you today. We have an old friend of ours, Feras Moussa, who is going to be presenting today and talking a lot about multifamily and various other real estate types of investments that certainly I think will be of a lot of interest to current and potential investors going forward. But before we begin, I want to give you just the quick breakdown and talk a little bit about Quest Trust and who we are. First of all, Quest, we are the largest self-directed IRA custodian in the state of Texas. We currently have over 20,000 active investors across the USA, and we have $2 billion in assets under administration currently. Now, we have more than 100 employees that work here, many of whom are credentialed with the Certified IRA Specialist designation awarded by the American Banking Association. That shows an extra degree of study and dedication to the area of IRAs. And again, it's something here at Quest we feel very important and proud to have so many of our staff accredited in that way. Last thing I like to mention here about Quest right now is that currently we have clients who are sitting on about $350 million in unallocated cash. We have clients who are looking for deals. So our clients are continuing to utilize resources like these to potentially find deals. But if you're out there offering deals, then please continue to participate in our networking opportunities, because it's a great place for you to find potential clients and find a way to get your capital pool expanded beyond what you may think. Now, that being said, let me just preface this presentation by saying everything we're doing here is purely for educational purposes. And we at Quest Trust Company, we do not offer tax, legal, or investment advice. And we always recommend that whenever you're engaging in any kind of a transaction, of course, you do your due diligence first and make sure that you seek out counsel from any kind of legal, tax, or investment advisor that you may use. Now, a self-directed IRA, it's really no different than an IRA you're going to find anywhere else. In fact, I'd argue every IRA is self-directed to some extent, because with an IRA, you're establishing the account and you're choosing what to put your money into. The distinction, however, that in the self-directed IRA is that it lets you truly pick the asset that you are investing in. What I mean by that is if you take your money over to, say, Vanguard and set up an IRA and invest in one of their funds, you are buying what Vanguard offers. Moreover, you're handing it over to a fund manager who then invests it really without your consultation or your knowledge or your approval. So in a very real way, you're putting your money in their hands, but you have no control over the direction of the investments. Now, that's completely different with a self-directed IRA, because it is you who is choosing the asset in which you want to invest. So there is that added diversification that you can get by using a self-directed IRA, because you truly can buy an asset that doesn't correlate to something from a more traditional provider like a Vanguard, a Charles Schwab, or Fidelity. Now, IRAs across the board really offer all kinds of tax savings advantages. Some of them offer tax deferrals. Some of them offer tax deductions. Some of them offer even tax-free distributions. So there are a lot of advantages for a lot of different purposes. So it's a conversation that we always like to have. And as I was saying before, the self-directed IRA, unlike anything else, really lets you invest in the things that you are personally familiar with. As a result of that, it's perhaps less likely you're going to be surprised by the outcome of the investment, because of the fact that you have done the research, you've done the due diligence, you've done the homework. It could be an area of your personal expertise, and it's giving you the ability to take advantage of that. And you know what? There's one other thing I would add that I think self-directing IRA does that's rather unique. And I think it comes of a little bit of a social investing element. Now, we've all heard of social investing. It's that idea that I'm going to invest in a company that's going green or that has a lower carbon footprint or things like that. And that's well and good. But here, I would say in a self-directed IRA, you have the potential to make more of a local impact on your community that benefits it more than any other kind of investment. I mean, think about it for a second. You're buying a piece of property. You want to flip a house. You're buying the ugliest house on the block. You're putting your capital into it. You're also putting materials and manpower into it. So you're hiring local labor, you're sourcing materials locally, you're injecting money into the economy that's going to make a more of a difference on that local level. And that would be true across the board, whether you're lending your money to somebody who's going to do the same, or whether you're investing in multifamily syndications where the outcome is going to be the same. It's all the idea that you're putting your money into something that's going to show real improvement in an area in a very short period of time. Now, the types of accounts, as I mentioned, they come in all different varieties, and they all offer different kinds of tax advantages to them as well. There are the personal plans, where with the traditional, you use pre-tax dollars, and the Roth, we use after-tax dollars, which we know we can get back completely tax-free. The employer plans, these are ideal for anyone who has a small business or is self-employed. They can offer a lot of benefits, including higher contribution levels than you could make to a personal, traditional, or Roth, and also the ability for some of those contributions to be tax deductible to you on the business side. And then finally, the specialty plans, health savings account and the education savings account, which give you the ability to put money in and take money out tax-free for qualified expenses, that being either healthcare related or education related. And it's really interesting as you start to look at what that definition is of qualified health expense or qualified education expense. It's a lot broader than you may think. So it really means that those dollars, which you can take out tax-free, can be used for a variety of different things that you might not expect. All right, just to talk a little bit about what Quest has coming up. We have resumed our self-directed IRA socials live now, and we're very happy about that. So it's going to be every first, second, third Tuesdays of the month. The first being in Houston, second Austin, here where I am, and the third in Dallas. So we have featured speakers. We have those networking opportunities that I talked about live. And of course, we have great education that we're going to be providing, as well as food and drink. So if you're local into the area or you're going to be nearby, please feel free to register and sign up. We'd love to see you. And don't forget, too, even if you see a topic that is of interest to you, we simulcast these presentations on YouTube. And of course, they're always archived. Also, we've got the ongoing classes and webinars that we are conducting. Again, we're getting back into some more that are going to be live periodically. Of course, we have the classes like this today. We have our Tuesday class. Our virtual happy hour has also remained in place. That was very popular. We were doing that in place of the socials during the COVID days, but everybody really enjoyed it, so we kept it on. It is now the fourth Wednesday of every month, so it's right at that end of the month. And of course, as I mentioned before with the socials, everything we do, it's archived on our YouTube channel and our Facebook page, so check it out. All right, last thing we want to talk about is Quest Expo. If you haven't heard about this, look into it, please. Look at questexpo.com. There is going to be a 3-day event here in Houston. It's the biggest event we put on every year. There are going to be speakers from across the country, 3 days of great content, great networking, and again, a lot of one of the things I think that's key that I really like about Expo is that with the wide range of vendors that you're going to meet there, you really have a chance to build your network, build your team. This is where you can potentially meet people that can do all of the, vertical integration of things that you need, like property management, renovations, things like that, things that you may not really think of as you're going into it, but you're going to find that you really need as you go along and continue to succeed. All right. So as I wrap up, this is how you can get in touch with us. If you want to scan that QR code, that will put you in touch with an IRA specialist. You can also just go to our chat box on our website. That's available during business hours, Monday through Friday, 8:30 to 5:30 Central Time. You can always call us or shoot us an email, whatever works for you. By the way, if you are interested in Expo and you reach out to us, we still can also provide a discount. So please feel free to reach out. If there's any way we can help, please do. All right, with that, I am going to go ahead and prepare to turn this over to our good friend, Ferris. It kind of went a little wonky on me there for a second, Ferris. Sorry about that.
Not a problem.
These are the things I really get used to so much, it seems.
Happens to the best of us.
So as I turn it over to Ferris, I'm going to talk a little bit about him here. He is a real entrepreneur. He actually comes from a bit of a tech background, which is, it's kind of interesting. I'm seeing a lot of that lately, Ferris. A lot of people who started out in IT and have moved over into development. I'm not sure what that says about the industry, but there's one guy in particular who tells me that he's an escapee from California, but he came from that same kind of background. Ferris himself, though, he's been here in Texas for a great deal of the time, graduated from UT, worked for Microsoft, and then really found real estate as being the area that he wanted to go into, started building a portfolio of various types of assets, and now is doing it full time. He works with a partner, Ben Suttles, and they basically both co-founded what's called Disrupt Equity. So they are big into the area of multifamily, and I'm sure Ferris is going to have a lot of information for us. So Ferris, you ready to take it away?
Ready when you are, Steve.
Great. Thank you very much. And I'm going to be monitoring the chat box. If it's okay, we'll collect questions as we go along, and we'll do a little Q&A at the end.
You bet. I think Q&A is always one of the most valuable parts. So I try not to keep the presentations long to kind of let people really ask the things they want to know.
Exactly. All right. Great.
All right. Well,
thank you very much.
No problem. Well, thank you, Steve, and the Quest IRA team for having me on. Always a pleasure and always a phenomenal team. Definitely one of the best, I like to say, in the IRA space. So with that said, hello, everybody. I'm Feras Moussa. I'm here to talk about basically why the rich invest in multifamily real estate to build wealth, right? And, we titled this because it's really, I like to tell people there is not a better way to build wealth in real estate. It's not a get rich quick scheme, but it does, you do build wealth over time. And I actually read a book many, many years ago when I was first getting to the space. It's written by Tom Wheelwright, and it's called Tax-Free Wealth. And it really opened my eyes into the ways people build wealth and how, and why the rich do some of the things they do. And more specifically, why they invest into real estate, obviously, but even other facets, right, around why they invest into oil wells and some of these other things. So, with that said, Steve did a great job introducing me, so I'm not going to really repeat it. But as Steve mentioned, I did come from tech. Was at Microsoft, and he kind of alluded to there seems to be more people in real estate that came from tech. And for me personally, it's the things that I love. It's people's numbers and systems. And so started Disrupt Equity many years ago, and we've continued to grow. And so, with that said, Disrupt Equity, we're a vertically integrated firm. We're based in Houston, Texas. We also have our own management company, and combined, it's about 140 employees, and we are actively buying real estate to date. And so we've done over $300 million of acquisitions, and we're doing about another $250 million over the next 3-4 months. And, we've done many deals full cycles, and really the deals have averaged between 20 to 100%. That 100% is we've literally had one deal that was just a home run. I'm going to talk about some of those things and why you can have these home runs occasionally in real estate. And so, and here's a couple of the deals that we've sold over the time. I think there's a few more that we sold recently that are missing off this slide. But, for us historically, Atlanta and Texas are our main two markets. We are growing into Florida this year. So first time kind of expanding into that market. But we do buy in markets that are landlord friendly, and really have the growth that we are looking for. So we look for states with job growth, population growth, and some other metrics to help, I like to say, basically make our job easier, right? Because not only can we model out the rents and what we can do on the deal, but the market also improves and continues to help push things along. And so for those that don't know me, I'm a very candid guy. And like I kind of alluded to with Steve, happy to do Q&A at the end, answer a lot of questions. And I really like to share what I know, right? I think what I tell people, a good investor is an educated investor. And so for those of you that are new to the space, the more you can get educated, the better, right? I highly recommend getting out there, watching videos, like QuestRA produces a ton of content. Disrupt Equity, we produce a lot of content on our Facebook and YouTube pages. And there's a lot more out there. So definitely get out there, get educated, learn the space before you hop in. So I like to be candid. I'm just going to brain dump what I know, but please, before we make any big, important life decision, legal decision, tax decision, please talk to your professionals. Don't assume that I'm right. I may have some slight mistakes in what I'm saying. But with that said, the agenda is pretty straightforward. So first, I want to kind of dive into why multifamily real estate for those of you that are new to it, right? Then I want to talk about really kind of the thing that's been all over the news, right? Inflation and how that impacts multifamily. Then we have a slide in here that basically talks about common returns. I think we get asked that all the time, like what do returns look like? What can I expect? And so I'll talk about some of that. And then, basically we'll close it out with talking through how we can get started and opening it up to Q&A. So first of all, right, this slide I think is really powerful. So before I hop into the slide, I want to tell people a little bit of a story. So for me, as I mentioned, I was at Microsoft and, I had some more disposable income I was looking to invest. And most people in tech, they only know stock market, right? That's what everybody's kind of taught and educated. And you don't really realize you can do other things, right? You think that the apartment down the street must be owned by some huge company. And I'll talk about that here shortly, but it's not, right? And even, the entire business that Quest IRA is in is helping people to realize that they can use their self-directed IRA and invest it into something other than the stock market, right? And so for me, I bought a fourplex about a mile and a half from our offices today, coincidentally. Then I bought a bunch of houses and I realized it did not scale very well, right? You can build wealth in a million different ways in real estate. And so I do highly recommend just get into real estate. Then from there, figure out what you like. But for me, houses worked out well, but it just didn't scale, right? And for me, I was starting to realize I loved real estate, I loved the business, and I wanted to do something a little bit more scalable. And so, that's ultimately how I stumbled upon multifamily. And the joke I have is that my very first purchase that I tried to do many years ago was a 32 unit deal in Conroe, Texas, which is just north of Houston. And I'm glad I didn't win it. And fast forward 4 years later, the same broker had a deal that they were selling that was like a $70 million deal. And the broker asked me, how did you go from the 32 to the 70 million, right? And I asked him the same thing. How'd you go from listing the 32 to the 70? And so, with that said, these are kind of some of the vehicles of why personally, I think multifamily is powerful. First and foremost, cash flow and distributions, right? We and most operators look for deals that have cash flow in them, right? We're not buying to bet on appreciation. Appreciation is gravy, right? But we look for deals ultimately where that there is cash flow. Most of the time that we basically buy a deal, you put money into it, right? So we raise the money with our investors, we acquire the deal, right? The investors are buying shares in the LLC that owns the asset. But as part of that business plan, we're typically putting $1 million, $2 million into the property to make it better, right? Make it safer, make it updated, clean it up, making the interiors nicer, adding amenities, right? You really start to build a community, because what we've seen is the more we can build a community, the better it is for everybody, right? Tenants love where they're at. Tenants want to renew. Tenants, they will, you can push rents. Tenants will complain if someone else is doing something wrong, right? So we typically go and make these properties significantly better and improve them, but really with the goal of getting to a point where we can produce strong returns for our investors. And so with us, we do monthly distributions, but again, most people are doing quarterly distributions or, semi-annually. And so that's first and foremost. Next up, and this one's actually a huge one, is that with, and I kind of allude to it a little bit later in this diagram, but with multifamily real estate, you can afford to do what's called cost segregation. Cost segregation, what that means is that we have a company come do a study that separates out the asset and says, okay, this property, yeah, it has, the building, but it's got, 200 appliances, it's got 400 toilets, it's got whatever it has. And those things can be depreciated at a different rate than the house, right? For those of you that have a house, your house today can be depreciated over, I think, 27 and a half years, right? You depreciate a very small amount and you don't get a lot of losses. Real estate, it's a whole nother point, and I'll get to that here on the two blocks later. Next up, we can do what's called forced and natural appreciation. This one's really my personal favorite. And so for those of you that maybe did residential, right, the way a house is valued is based on what the other houses in the neighborhood are selling for. So you can ultimately, you really can't do much more than being the most expensive house in the neighborhood, right? It's not, if your houses are all selling for 300,000, maybe you could get a house sold for 330, 340, 350, but you're not going to be able to sell a house for 800,000, right? It doesn't make sense. Well, with commercial real estate and specifically with multifamily, right, it's valued based on how much income the property produces. And so what's nice about that is that if you can figure out ways to produce more income, right, you actually increase the value, and it's called forced appreciation. And so if we double the NOI on a property, right, we've significantly improved the value of the property. So think things like putting in carports, right? So maybe the property doesn't have carports and we install carports and now we get to charge an extra $30 a month per spot. Maybe you get to basically, update the interiors and have an upgrade package for people. Sometimes it's easy as basically putting in a tech package where people will pay for you to upgrade their lock and their thermostat and make them smart, right? There's a lot of these things. I'm not going to dwell on those, but by doing those things, we improve the value of the property, which then allows us to do other more creative strategies, right? We can go in, improve the property, improve the NOI, and then maybe a year later pull out all of the money with doing a big refinance and give it back to the investors. But guess what? Now we own the property free and clear. And so that's my favorite kind of way to do it. We have a property right now that we're in the midst of basically getting to that point. And so that one's a huge one. The next up, and this is the one that really why wealthy people invest in real estate. And I kind of alluded to it with cost segregation. It's the tax benefits, people. It is a very powerful vehicle where you get losses, right? And I know Trump, for those of you, regardless of what side of the political spectrum you're on, there was the news that was going around where he hadn't paid taxes in 10 years or something, to that tune. Well, the reason for that, folks, is because he's heavily invested in real estate. And with real estate, you can produce significant losses. And now there's people that argue, okay, is that a loophole? No, you're actually doing what the government wants to do. Tom Wheelwright actually says this well whenever he presents it. He really talks about the fact that by doing what the government asks you to do, you're actually, more patriotic. And so we can produce significant losses on these properties, right? And the government gives us that because by buying properties, we are creating jobs. By improving the interiors, you're creating jobs and you're building communities. And so for us, an average deal is probably producing about 50% of the investment as a loss year one. So for someone puts in $1 million, they might get a $500,000 loss in year one. And it's a paper loss, folks. And you could then take that loss and apply it to your taxes and basically save money elsewhere. And so I'm not going to go into the tax thing. It's a long, big, complicated thing. Please talk to your CPA. But we literally produce to our investors K1s that says negative $50,000, negative $100,000. And to go on a quick story, I had a friend who invested in first commercial real estate of his life on one of our deals, and he basically invested. And year one, we did one. That was a deal that we closed on towards the end of the year. We did one distribution before the end of the year, and then we gave him his K1. And he was just blown away. And he called me. He's like, "Hey, I invested. I think he invested $100,000 in that deal." And we had given him about $55,000 of losses. And he's like, "How did I get $55,000 of losses, even though you guys paid me out a distribution?" Well, it's because we did cost segregation and we were able to get those losses. And then he was actually able to take that $55,000 of losses, apply it to $55,000 of income that he had made elsewhere, and really basically save, $20,000 of taxes. And so, very powerful vehicle, and it's a reason that people that are in real estate continue to invest in real estate, right? Because you want to constantly build new losses to offset the new gains. Next up, it's a low interest rate environment. I know interest rates have been going up over the past quarter or two, right? I think we know that very well, but it's still very, very cheap debt, folks. 3-4% debt is very, very cheap than where it has been historically. And by buying that deal with debt, you're actually able to produce more income, which then alludes to leverage, right? Again, by leveraging your deal, right? People talk about smart debt and dumb debt. Well, real estate is considered the smart debt, right? I'm buying a property, I'm paying a bank 4% interest rate on it, but that property is producing 10%, maybe it's producing 8%, right? Because I brought in debt that needs a slower return, I'm actually able to increase how much profit I'm generating based on my contribution, right? And by mine, it's us and our investors. And last but not least, scalability, right? And again, I gave you guys a story. I almost bought that 32 unit deal, and I'm always glad I did it because had I bought that 32 unit deal, I would probably not be doing what I'm doing today, right? Because a 32 unit deal, it's really not big enough to have full-time staff, right? Versus if we're buying today, we have a deal that we bought last year, 530 unit property that has I think 11 full-time employees at that property, right? It allows me to scale. I don't have to watch everything that's happening at that property. We have a team whose job it is, and then we monitor the team, right? And again, it allows you to scale. And so your money is arguably a lot safer because you have people that are focused on it and are experts in that field. And so that's really the big circle of why multifamily is a wealth creation vehicle, right? If you combine all these things, it turns into a very powerful thing. And and I wanted to kind of talk through an example. So in tech, right, a lot of times when I tell people real estate's a great investment, what do most people do? Everybody's a genius, right? Especially in tech. Everybody knows how to go Google and say real estate versus the stock market. And what do most people see? They say, well, look, the stock market averaged 11% the past 100 years, and your deal is producing only 9% cash on cash, right? Yeah, that's right. But is it, more profitable to do to do stock market? Well, no, because you have to factor all of these things, right? The amount of losses that I'm producing for people that I can then take and offset with gains is huge, right? We're getting leverage, you're getting basically paid on of the note over time. You're getting all of these factors becomes a very, very powerful vehicle. And that's ultimately why I think real estate is much, much better than stock market. So, and I think that's ultimately again why wealthy people continue to invest in real estate. These things compound, these things have become very powerful. So next up, right? Now we talk about passive investing, right? So really quick, what does disrupt equity do? What we do is that we go out and we find assets that buy, right? We underwrite, I think right now we're averaging across the team about 40 deals a week that we are underwriting, vetting, trying to see which ones, make sense. We identify one to buy, then we put together the deal, right? And putting together the deal means putting together the debt, putting together the partnership, putting together all the legal paperwork that's SEC compliant with our attorneys, and basically packaging and putting together the entire business plan, vetting the deal, doing the due diligence, etc. But ultimately, with the goal of basically presenting it to our investors, then we put together a presentation and allow people to basically buy shares in the LLC that owns that asset, right? And so that means investors are actually shareholders in the entity. They get a K1 from us for taxes every year, right? They have some decision-making authority, right? And so it's basically by doing that though, right, it's kind of, we call it the active investor, the passive investor. We are the active investor. We're the ones that are having to deal with the day-to-day problems, et cetera, et cetera. For the passive investor, it is very passive. And so really, it's a low time commitment. What do most passive investors do? They usually watch our presentation, they then complete the paperwork and they wire the funds and they sit back and relax, right? And then for us, we do monthly updates. That's it, folks. It's a very passive investment for people. Next up, right, cash flow distributions. And again, we do monthly distributions, right? And for those of you that are new, go get to know operators, get to know other operators. Find someone that you like, right? Find someone that has the type of mentality that you have, they're approachable, they have the same business plan or mindset that you have as well. So for us, we like to call it mailbox money, and to me, it's not mailbox if you're getting it once every 2 years. Sorry, twice a year. That's why we moved to a monthly model. Um, Tax benefits, I talked about that, but again, you get cost segregation, and you can do a 1031 exchange. And I'm not going to bore people on it, but what a 1031 exchange is basically saying, look, I've made $2 million of profit. Actually, I'll give you an example. I was talking to one of our investors yesterday. That person has over $20 million of profit that they generated on a deal. They want to 1031 it into the next deal, right? And so what that means is that they are telling the government that, hey, government, I'm going to follow the rules of a 1031 exchange, and instead it's paying taxes on my $20 million of profit, I'm going to move it into another piece of real estate and not pay taxes. And so that's what a 1031 exchange is, and it's a very powerful vehicle, right? And so again, you continue to build wealth over time. Next up, we talked about appreciation, right? And for, in terms of forced appreciation, but you also have natural appreciation. We buy in markets that have job growth, population growth, and people want to be there, right? And so over time, we get natural appreciation because demand continues to drive up. Um, Next up, access to a strong, stable asset class, right? I mean, multifamily is a fantastic asset class. And, we saw what happened during COVID, folks. The government kind of reiterated that basically people need to drink, eat, and then finally sleep, and the government's going to support that. And so that's why we've seen just the increase in interest in multifamily over the past 2 years. And last but not least, we can't, of course, we can't forget this one: ability to use your self-directed IRA or solo 401k, right? Please, folks, if you have an IRA, talk to the Quest IRA folks. We have probably about 25% of our 20 to 25% of investors come through a self-directed IRA, right? And so we're going to raise about $80 million over the next 4 months. $20 million of that is going to come from a self-directed IRA. So it's a very powerful vehicle. Definitely get that checked out as one of the ways that you can invest money. It's not just about the cash on hand. It's about, other options to invest in. Again, talk to operators that accept it, because as an operator, there is a little bit more paperwork that we have to do. But again, we accept self-directed IRAs. And, the thing on everybody's mind, inflation and where are we at today, right? And really, what's happening in the multifamily space is pricing continues to go up, right? And with inflation, guess what? Rents are typically going up. So multifamily is a very good hedge against inflation, right? Because now that asset is producing even more income, and therefore the value is actually going up. And so, as we saw, right, for ending in March last month, 8.5% for that past 12 months. That is a huge amount of inflation, right? And again, highest since December 1981. So inflation's here, folks. Is it here to stay? TBD, right? But again, multifamily is a really, really good hedge against it, because not only do we have, growing rental demand, right? Now with interest rates going up, you're going to have the housing prices get more expensive. And so people that may have bought a house actually end up becoming renter instead, right? And as mentioned, multifamily real estate is a necessity-based asset class, right? What we all saw during COVID was that Starbucks down the road. I'm a big Starbucks fan, for those that know. Well, guess what? That Starbucks doesn't have to be open, right? People don't have to go buy lattes, but guess what? They have to have a place to sleep and live. And so multifamily, was proven as kind of the bell out the ball, right? It was the asset class that blew everyone away during COVID, and it's just continued to produce more interest because of that, right? And as I kind of alluded to, it has the ability to adjust rents with inflation, right? And with inflation, not only can we push rents, but also because of inflation, the price to rebuild or build a new apartment actually goes up. And so the replacement cost is increasing. So therefore, your deal becomes even better deal, right? Because if I can buy a deal for, $200 a foot, but today it costs $300 a foot to build a very similar deal. Well, guess what? My property is becoming more and more valuable, right? Let alone that now my rent that maybe was $1,100 is $1,200. And so really powerful stuff again. And it's not about one thing is right versus wrong. It's about combining all these things into one very powerful vehicle. So this is the question that we get asked all the time, right? What do returns look like in multifamily, right? And so what we presented to investors 5 years ago is different than what we present today, right? The market's gotten a little bit tighter, right? But today, most deals that we're doing, they're in that 7 to 9% cash on cash returns. And for those that are new, what does cash on cash means? That means for every dollar invested, what return you're getting back on that, right? And so it's taking into account how much leverage, how much, et cetera, you have in the deal, but really this ultimately what is actually being distributed to investors. And so most of these deals, it's about 8%, right? And again, typically it ramps up, right? Whenever we first buy a deal, we're going in, we're improving the property, right? It takes us about 12 months to get the rents and things improved or get the occupancy up, et cetera. And so most deals, you're looking at about 7 to 9% cash on cash. On an exit, we're typically making 30, 40, 50% on the exit because, again, we did that forced appreciation combined with natural appreciation that we talked about. Most deals are 5 to 7 year holds. And, again, most operators, the minimum is 50 to 75,000. We have a deal right now, it's 100,000 minimum that we're doing, right? So, but that's what you can expect, right? Most operators are not going to accept $10,000 investments, right? It's really going to, because again, if we're raising $50 million, it's really hard to do that $10,000 at a time. And so that's what you can expect, right? And so that really, what does that all package into? That really, in the end of the day, your average annual return is about 15 to 20%, right? Internal rate of return, or sometimes called the IRR, again, it's going to shake out at 10 to 50%. Cash on cash, 7 to 12%, all in. Total return, again, doubling money in 5 to 7 years. And a lot of people offer a preferred return. We offer a preferred return. And if you're a new investor, I highly suggest investing in a deal that offers a preferred return. And what that means is that basically you as an investor get a return on your money first before the operator can participate in any splits. And so if a deal is not performing, but let's say a deal never pays a distribution, then it gets sold. Well, what's nice about a preferred return is that you actually have to be caught up on the preferred return. So if we offered you a 7% preferred return, pay 7, 7, 7, great, that's 3 years. So you get 21% return on your money first, then anything left over is being split between the operator and the investors. And so that's what a deal looks like today. And again, that's what we present, but we go into these deals, I like to say opportunistic, right? We sold 6 deals last year. It was a great time in the market. All 6 of those deals were deals that we had presented to be 5 to 6 year holds. All 6 of them we sold, much less than that. We sold them in the 2 to 4 year mark, right? And so, what I tell people is go in with an open mind. This is what you can expect. And again, if you have that home run deal, then great. And I'll talk about, maybe one of the home run deals that we had. We had a deal in Beaumont, Texas, which is east of Houston. That deal in the course of 2.5 years produced 300% return for our investors. That is phenomenal, right? I mean, that's not what you can expect today, right? But occasionally you get these home run deals because not only did we force appreciation, you got the natural appreciation, plus cap rates went down. So the valuations for multifamily went up. And so all those things combined, plus we bought the deal right, resulted in a home run. And so with the stock market, it's very hard to hit that 300% return deal. You can get them, but again, what I love about real estate is that as a investor, as an operator, you have a lot more ability to impact change. And so it's huge, huge, I think, kind of bonus as to why real estate and specifically multifamily is awesome to be in. Right. So how do you get started? Right. You get asked that all the time. First, as mentioned, go get educated. Right. Make sure you're comfortable with what you're investing in, and find what define your criteria. So get out there and decide, okay, I really like the market of Atlanta. I don't really like Phoenix, Arizona, because I think it's a hyper market. I'm just giving examples, right? I don't have an opinion on Phoenix, but maybe you have a reason you like one market and not the other, right? Maybe you see that, okay, one state is doing things that you think is going to start to hurt the real estate market, et cetera. So find your criteria. Maybe you want to be in the nicest deal in the nicest area because you're betting on the area and you're okay taking lower returns. Maybe you are looking to maximize your return and you're okay with taking on a little bit more risk, right? Everybody, different strokes for different folks. So first, find the criteria, the box that you like. Then get out there and network and meet operators, right? We are obviously a sponsor or an operator, right? Those terms are synonymous, but get out there and meet people. Find someone you like, right? Someone that you can connect with, someone that's available. Our investors love us because they know that they can email me, text me, and 9 times out of 10, they get a response very, very quickly, right? Even as we've grown the company, the company, like I said, 120, 30 people now, we still have that. That's our level of touch. I like to say we give our investors white glove treatment. And then ultimately invest in your first deal as a passive investor, right? Once you do that first deal, you start to understand how things work, get more comfortable, then you can continue to grow from there, right? And so get out there, go meet people, find that plan and jump in, right? And don't be the person that is just on the sidelines forever, right? There's not a better time to invest in real estate than today. And ultimately, we don't know what the future holds. But at the same time, as a good operator, there's a lot of hedges that you do to help mitigate risk. And so for us, we're buying deals today with more cash reserves than we had done in the past and at lower leverage, right? Just to reduce risk in case the market moves on us. And so with that said, I wanted to go ahead and break it out into Q&A. And so Steve, I don't know if any questions came in, but for those of you that may have questions, please go ahead and drop them in. I'm happy to answer questions about anything and kind of help steer people in the right direction.
Yeah. Okay. Can you hear me okay, by the way?
Yes, I can.
Awesome. Okay. So we have had some questions coming in.
Awesome.
First of all, the first one I saw, just wanted you to clarify a little bit the term vertical integration for the audience.
Yeah, so vertical integration, what that means. So some operators, I mean, most people getting started, they will use a third-party management company. And so what that means is that you are hiring another company to do the day-to-day management instead of your own employees, right? For us, we grew past that. We started Disrupt Management 2 years ago, and we actually manage our own properties. And so that's what vertical integration means, that we basically own the vertical of what we need for our business, right?
Yeah.
And so, maybe if another totally different kind of example, a vertically integrated, let's look at Airbnb, for example. Airbnb is not vertically integrated, right? They help source properties to renters. But now if Airbnb also owned all of their own rentals, I'd call them pretty vertically integrated, right? They own the rentals and they help, service and provide all that. So just another way to think about it.
Nice. Okay. Okay. Um, here's a great question for you.
Yeah.
Single family or multifamily?
Always a good question. So yeah, so I've done both. And again, for me, my story is I bought a fourplex, then I bought a bunch of houses, and I realized it does not scale. And so you can build wealth a million different ways. And I don't want to tell people multifamily is the only way to do it, right? But for me, what I learned is that I can pretty much get, even on our worst performing deals, I still got better returns than single family, right? Let alone the upside deals. And then it's
And
passive, right? And for us, it's like literally you get, I mean, I invest in every single deal that we do, right? I like to make sure I have skin in the game too. But again, it's for passive investors, they don't have to put anything in besides a little bit of time up front to fill out paperwork and
yeah,
fund it.
I think
So
that's really what it comes down to. Yeah.
yeah.
Do you want to be the
But
person in
now,
charge, or do you want
yeah,
somebody to just do
and
it
now
for
that
you?
said, if you know how to buy houses 10 cents on the dollar, by all means, right?
Oh
Go do
yeah.
that all day. So
Oh yeah. All right. Somebody was asking about the I guess you had mentioned something about the K1 and some losses. They were making the point, of course, that with an IRA, that doesn't really do anything for you. But do you want to talk just a little bit about maybe investing in these things outside of an IRA
yeah,
and
good
where
point,
those things come
actually.
into play?
Yeah, so as an investor in an entity, right, regardless of how you're invested, whether IRA or cash, right, you are a shareholder in that LLC. So for us, we are, let's say we're raising $20 million and someone invests $1 million. Well, they get, there's a structure, there's a split where they're getting a pro rata piece of that $20 million of that investment becomes their ownership in the LLC. Because they own part of the LLC, they are our partner in the LLC, and they get a K1, which is basically the tax schedule that we give to investors per the IRA. The IRS, sorry, one letter off. And so that now on the K1, it is really a form, just a one-page form that talks about how much money you earned on that investment. And so with our deals, year one is, actually, we've never had a deal that was positive, right? Year one, there's
Yeah.
always a lot of losses distributed. And so an investor gets a K1, it might say, you invested $100,000, it might say negative $55,000, right? Then you take that and you give it to your CPA, and you're able to hopefully possibly apply it against your income. Now that said, with a self-directed IRA, it's a different kind of taxing scheme. But it's, again, I'm sure there are clever people that have figured out how to still leverage those K1s, even if it's packed away into an IRA.
Well, I mean, if there's UBIT or
Yeah,
UDFI, that certainly can help improve that situation as well.
you bet.
So you only pay that if there's profit. So
Yep.
it's not necessarily like some of those things hurt you. And again, yeah, there are uses within the IRA itself. So good point. Good point. Somebody had I think just a general question talking about 1031s. There's always talk one way or the other about it staying, going. What do you have any insight on that?
Yeah, I mean, I think those talks have sizzled. They come and go every couple of years,
Yeah.
right? Ultimately, I don't see them getting rid of it anytime soon. It's a very powerful vehicle, and it's not just for wealthy people to keep wealth, right? But it's also, again, people don't realize transactions of real estate really keep the business, the economy thriving, right? Whenever we buy or sell a deal, there is a closing statement where 20 different companies have all made some money, right? And so that's an incentive. That's why the government likes it, right? Otherwise, people will probably cash out their deals. And so I don't see the 1031 exchange going away anytime over the next decade, but I may be wrong. You never know.
Yeah, I kind of feel the same way.
Yeah.
All right. So again, here's a question I hear all the time. Is it still a good time to go into real estate? Everything is so high. I mean, it's kind of funny, that question. I hear it a
Yeah.
lot. I heard it last year. I hear it this year. And
I've
I
heard it
used to
every
hear
year
it
the
all the
past
time
5 years.
well, yeah, exactly. But I used to hear it all the time about the stock market too, where
Yeah.
everybody's like, it's so high. So I know you were making some comments about that before. Yeah.
Yeah.
Expand.
So to answer that question, I mean, me personally, I'm continuing to invest in real estate. I'm going to make significant investments over the next 6 months, right? And it's about, guys, it's not about timing the market. If you're timing the market, you're doing it wrong, because it's really hard to time the market, regardless of if you're doing real estate or you're doing stock market, right? It's about hedging your risk. And so, as mentioned, I don't know if the market's going to fall tomorrow, right? I like the fundamentals of the markets that we're in. I like the upside. I'm not betting on the 1 year story. I'm betting on the 10-year story of that market, that deal, that area, right? And so, I don't know what the 1 year looks like, but it's about making sure that we can get to the 10-year point if we needed to. And so that's where, again, I'll tell you an example. We have a small deal that we bought in February of last year. So we've owned it for more than a year. That deal is a 12 or 13, small deal, one of the smallest deals we've done, a $13 million purchase price. and we raised about, I think, $4 million of investor money or $3 million. Well, that deal, we also have $1.5 million of cash just sitting there on the sideline in case things go wrong. That deal is crushing it. It's probably worth double what we paid for it, but we still have that money on the sideline just in case, right? And so we're hedging our risk. We knew we can have the extra reserves and it's still a safe investment. And if the market takes a dip tomorrow, it's okay because we can ride it out for the next 10 years. So, it's about not trying to time the market. It's about having the right fundamentals and then the right structure to support reducing risk.
I always used to say it's time, not timing.
Yeah, actually, there's another phrase. It's time in the market, not timing the market.
Yeah, exactly.
Yeah,
exactly. Hey, interesting question here. The investors, talk about accredited versus non-accredited as it pertains to your business.
Yeah, absolutely. So that's a good question. So for us, right? So whenever we raise money, right, to give people a little bit of an overview, there are a lot of rules that we have to follow, right? The SEC, basically defines guidelines that we have to follow in order to raise money, right? And we have to disclose things, et cetera, because with any investment, there's risk. And so there's two kinds of ways that are common to raise money, a 506B and a 506C, right? And for the investors, all you need to know is that with a B, right, that means that we can accept money from sophisticated investors, right, and accredited investors. Now, an accredited investor, there's a clear guideline, and it's changed, over the past year. But I mean, historically, it's someone that has a net worth of $1 million, right, or generated more than 200K of income 2 years consecutively. That was an accredited investor. Sophisticated investor, it's a loose definition, but ultimately it's someone that qualifies as a knowledgeable person, right? They are sophisticated enough to understand the investment they are in. And so what that allowed us to do was accept money from people that might not be with the net worth to qualify for accredited investors, but they were, they're knowledgeable, they're educated, and we could say this person understood what they're getting into and sophisticated. So for us as a company, we've done deals with both 506Bs and Cs. The other rules of the 506B, which is the sophisticated and accredited one, you have to have a pre-existing relationship. And so that's why I tell people, come talk to us, go sign up on our website, come have a meeting with one of our investor relations people. We want to get to know you. But as we've grown as a company, our focus has been 506Cs as of late, which is accredited investors.
Nice. And also one clarification question like before, give a little bit more of a definition on scaling.
Scaling. So scaling to me means continuing to do the thing you're doing, right, and produce more results without taking on a lot more burden. And I'm going to give you guys an example, a totally different example. Let's say I have a plumbing company, right? And I have one plumbing truck and I want to quadruple my business. I probably need to go have 4 plumbing trucks, right? So it's actually a lot of work. I have to go hire 4 more people. I have to get 4 trucks. I got to really scale out. I got to quadruple the back end, the manpower, right? But now let's say I'm Facebook. I'm a software company, right? This is why software companies are valued so high, because they scale very well. I'm Facebook. I have 1 million users. Let's say in a year from now, I want to have 1 billion users, right? To get from 1 million to 1 billion, I actually don't need to do a lot, right? I could probably, there's a company recently, $20 billion valuation with only a handful of employees, right? You don't need to scale out as many people. So therefore that business scales very nicely because the cost to grow is not, directly linear in relation to the effort. And so with that said, going back to what I said about, let's talk, bringing it back home to real estate, right? Single family did not scale very well. To go from 10 houses to 20 houses, I had to put in double the work. I had 10 loans, 10 insurance policies, 10 to everything. Whereas with apartments, multifamily, I have dedicated employees, right? We are going to double our company in the next 8 months, right? And I'm able to do that because the overhead to double is not linear in relation to where we are today. That was maybe a couple of different ways to answer that question, hopefully.
All I can think of is, who better to ask than an IT guy about scalability,
Exactly.
Real quick, I'm going to divert to answer just a couple of questions here about Quest. Okay. We had a question about minimums to open a self-directed IRA. We actually open accounts all the time with no money down, because usually money is being delivered over from another custodian, either by way of an IRA transfer or a direct rollover from a qualified retirement plan. And of course, contributions can always be made as well, but none of that has to be done at the time of opening the account. So just touch base and we can explain that further. There was also something about IRAs as the funding source with your deals. And again, it was just really, I think, what Ferris was talking about a little earlier. We're just another resource. So retirement plans have so much money in them right now. People like Ferris love self-directed IRAs because it's a great source of finding capital that's available. It's people who don't want to go into the market anymore or want to diversify away. And it gives them the ability to find people like Ferris who they really can vet and research and check the track record on and feel good about investing with directly.
Absolutely. And
All
Steven,
right,
I have two more slides,
more.
maybe really quick to go through. Then we can go back to questions. I didn't forget
sure.
that these are on here, but really quick, right? Well, one of the things to get people to get educated in is going to conferences. So we actually have a big one that we host. We do 3 of these a year. Our big one was in Houston. Quest is one of our big sponsors. We had 600 people there. We had the mayor of Houston there recently. Well, we're doing the next one in Seattle, July 23rd. And so for us, we don't make any money on this. It's really about breaking even and putting on really high quality speakers, high quality panels, and getting people educated. So if anyone's interested, would love to guys check it out. It's July 23rd in Seattle. We try to do it at a fun place that time of the year. I used to live in Seattle, and there's really not a better place to be in the world than Seattle in late July. So mfinvestornetwork.com. And then I guess that's my contact information for anyone that wants to reach out to me. So Steve, take it away. Continue on, I guess, if you have any more questions.
Well, we got that inevitable question, which we could probably have an hour to discuss about UBIT and UDFI and as it pertains. So given that that's a deeper conversation, I think we'll kind of defer on that a little bit. I mean, just at a high level, it is a type of tax that an IRA may have to pay if there is debt connected with the asset and the resource and there is earnings. So beyond that, it's a much deeper conversation. The one thing I always tell people with regard to UDFI and UBIT and any of those things is just because it may be applicable doesn't mean it's a deal you shouldn't do. Because of the way that it can be worked out from a tax standpoint, the tax implication can be virtually zero, basically. But again, that's a conversation that, please call us, call your CPA. That's definitely a deeper conversation than I think we can go into here.
That's my favorite kind of
question,
Steve, because I get to toss that one over to you.
Interesting question here. You, I guess, and your company, do you just do new multifamily or do you do rehab, combination thereof?
So our bread and butter has been just kind of value add, where we're buying 70s, 80s, 90s. We bought a deal recently, 2005 construction, and we are putting money into it and improving the property. We have done one ground up development where we partnered with another operator and we brought our investors into it as well. And hoping to do more of them. So ultimately, I like to say what we do, our business is matching deals to money, right? And so our investors is the money side, and we're finding good opportunities to place them into that we vetted, that we validated. 9 times out of 10, it's opportunities that we are also running, right? But we did do that one development and hoping to do more of those as well.
Mm-hmm. And then, just simply, again, give a definition of multifamily.
Yeah, so multifamily really, I mean, it's technically, right, a duplex, 2 houses, or a 4-plex like I bought, that's considered residential. So technically, multifamily is anything above 4 units. What we are buying is stuff that's 2, 3, 4, 500 units big, right? And so that's what we are. And it's just, think of an apartment complex, right? And it can be your garden style apartments that many of you see here in Texas, right? It could also be a high rise that you see maybe more likely in New York, right? There's not one or the other. It's all considered multifamily. And it's just, a set of, one or many units that more than one person lives in, or more than one household, to be more correct, lives in.
And here's another interesting one. Let's say, you find a property. What are the things you do or recommendations in terms of evaluating the property?
Yeah, so that's a
seminar too, right?
Yeah, that's a seminar. Exactly. That's what I was thinking. So for us, the first thing we do with any deal, even before we look at it, we underwrite it, right? We look at the financials, we study the market and say, is there an opportunity to make this property better, right? And that could be, hey, the property down the street has granite. This property doesn't have granite. we can do that and, get better rents. It could be, hey, this property is being severely mismanaged. It's only at 50% occupied. It's because the management is terrible. We can go in there and manage it better and do a better job. And so, you could, that's kind of the first thing we do to make sure it passes a sniff test. Then, we get out there, we go tour the properties, get eyes on it. And once we get it under contract, we do a full blown due diligence. We get out there with our team. We have the team walk every single unit. They take photos of every unit, and we know exactly what we're buying. And if there's some things that are concerning, let's say we saw some foundation stuff, or we keep hearing that there's pipe problems, right? We get out there and get the experts out there to look at those things just to make sure that we have enough cash, to be able to address those issues and improve them, right? And so, those are some of the things that we look at, and ultimately you learn to know who you buy from, right? That's a big part of my decision making. If I'm buying from a big institution, I know that they've probably done things correctly versus I'm buying from the mom and pop owner. They might have cut a lot of corners.
All right. Interesting question here about somebody asking about their Roth 401k. Again, with what we're talking about here, those are funny monies that you could move over from a Roth 401k into a Roth IRA and invest through there if you're eligible to use it. There is also something called a solo 401k if you're self-employed, which you can set up, which can have a Roth component. And one of the nice things about the solo 401k is pertaining back to the conversation about the UDFI, the unrelated debt financing income. That's one thing that's actually exempt from that. And somebody is just pushing another question about the UBIT UDFI. It's important to just note that's a tax that's not paid by you personally. So any of those taxes don't cross over into your own adjusted gross income. They're paid by the IRA. So it's a separate entity that's going to file and pay the taxes accordingly. And so whatever that income level is, that's where the taxation is going to occur. So again, when you factor out what you can deduct against it, it may not be very significant at all. And again, now I'm going to not say another word about it. But hey, we do have a few more here. Let me see. How long does a deal when you have hundreds of units take usually? The time from finding prospective property to closing and then beginning operations?
Yeah, so the first thing is finding that first deal. And for us, we have 5-6 people dedicated. And it's funny, we kept losing. And then now we have 5 deals that we're buying over the next 4 months. And so you never know when the right deal is going to show up. We're patient. We don't want to get into a deal that we can't perform in, right? But once you identify that deal, typically as part of the contract, you have 60 days to close it. And maybe you get an extension in there. And so you're looking at 60 to 90 days to buy and acquire the property. And so, once we do that, I mean, it's, once you get a deal under contract, it's busy. You're lining up the debt, you're lining up the insurance, you're lining up the due diligence, the inspections, you're doing, all the legal paperwork with your attorney, you're raising the money with the investors, you're doing the presentation to raise the money, you're getting bank accounts open. All of these things happen simultaneously in that 60 to 90 days. But once we acquire the property, from then on, it really depends on what the business plan is, right? And so for updating interiors, typically, you can maybe get 5 to 10 units done a month in upgrades. And so do the math, right? If you're doing, we have most of our deals, like actually, I'll give you an example. We bought a 530 unit deal back in August. As part of our deal with the lender on that, we're going to upgrade 200 units. And we have 2 years to do it. So do the math. We have to upgrade 100 a year, which is about, 8 to 9 a month that we need to get upgraded. And so we're rapidly tracking that. And then we draw the money from the lender and we, work through that. And then ultimately, at that point in time, we're stabilized and, we're just producing cash flow.
All right. We're going to wrap it up here, I think, pretty quick. We're just about the top of the hour. Somebody was asking about meetups in Dallas. Best place to find that is Meetup itself. But please do remember that the Dallas Self-Directed IRA Social is every third Tuesday of the month. And often we do host meetups at our offices as well. So you might find some information there. And again, just check our events page for that.
And we have a big one that we host in Houston as well. So ours is the first Thursday of every month. If anyone wants to come check it out, we get usually 100 to 150 people out there. So love to come check it out. Again, another environment to go meet other people, meet investors, meet operators. You can go to our website, you can register and check that out there.
And does that work for you? Because again, just the last thing before we close out, somebody was asking, like, do you find your deals through wholesalers? But again, I mean, I hear people, they find their deals a number of different ways.
Yeah, the stuff that we are buying, though, it's such, it's bigger dollar, bigger price points, that it's, you don't really find the mom and pop person that someone can wholesale it. It's almost always done through a broker one way or the other. But the way we get deals is the brokers love us. You want to be an easy buyer. You want to be the person that they want to call whenever there's an opportunity. I mean, to get a real example, we have a deal that we're buying in Atlanta where essentially the seller told the broker, hey, I want to do this off market, right? Please present this to your 4 best groups and see if anyone wants it. And here's the price that I want for it. We got the call. We were one of those 4, and that was a deal that we liked. And we're like, yeah, we'll buy it. So,
all right. Well, why don't we end there? We are at the top of the hour.
Perfect.
Ferris, this has gone pretty fast. I don't know about you.
No, I agree. It definitely flew by, but thank you very much, Steve. Thank you.
We had a pretty good audience, and they were shooting a lot of questions in here, some of which I hope you'll call us, because again, I think a lot of these are good conversations to have with myself or one of my teammates. I put my email in there as well as my link to Calendly, so feel free to reach out to me directly. But Ferris, I just want to say thanks again. This has been tremendous.
You bet. Thank you, Steve.
All right. Have a good day, everyone. Thank you.